So hello everybody and welcome to Summer 1 Business 330. What I'd like to do now is just go through about 40 something, maybe 45 or 46 slides for Chapter 1, and I'll make a video and send it to you. And if you have any questions, feel free to email me. Excuse me. All right, so the Chapter 1 is basically a boilerplate, and it's called The Role of Managerial Finance. And it's just going to give us a simple introduction. And here's some of the things we're going to learn. We're going to define some terms, finance, and define managerial finance, and look at a couple different types of business. And the big thing is we're going to describe the goal of the company and the people who run it. And the most important thing we're going to learn is the concept of maximizing the value of the firm, also known as maximizing shareholder wealth, because the shareholders are the true owners of the company. So, the most important definition here is finance can be defined as the science and art of managing money. And that's what it's all about. We're going to be talking about managing money in this class. And at the personal level, you all know that you have to manage money on your own personal level to run your life, right? So your life is like a little business, and how much you save and how much of the earnings they spend and how they invest their savings. All right, so as far as a business, how firms raise money from investors such as stockholders and bondholders, and how firms invest the money to earn a profit, and how firms decide whether to reinvest profits in the business to grow the company or give them dividends back to the stockholders. All right, so I'm going to go through some of these slides rather quickly. Here is some slides on different careers in finance, which you can read in your textbook. And the managerial finance is going to be, the definition is concerned with the duties of the financial manager working in a business. And financial managers administer the financial affairs of all types of businesses. Basically, they take care of all the money, just the way you're a financial manager in your own personal life, right? And the financial managers try to create profit and make money for the shareholders or for the investors. Okay, so again, here's some professional certifications that people can pursue in finance. Chartered financial analyst and certified treasury professional and certified financial planner. And you can look these up in your book or online and learn about these yourself. And here's a couple more, basically Academy of Financial Management and professional certifications in accounting. Okay, so there's a couple different legal forms of business organizations. Whoops, sorry about that. Let me go back. So we're going to learn about a sole proprietorship, which is basically just a business owned by one person, and a partnership is a business owned by two or more people. And then, of course, there's the infamous corporation, which we all know and love, which is owned by many people, and it's a legal entity, and it's basically owned by shareholders. So if you guys own stock in a company, you're the owners of the corporation, right? We all are. So if we have stock in Apple, we're basically the owners. Millions and millions of us, right? Okay, so here are some of the strengths and weaknesses of the common legal forms of business that we just talked about. Here's the sole proprietorship, and here's the partnership, and here's the corporation. And you'll notice here, and let me just underline a couple of things. You have strengths here, and you have weaknesses here, and you could basically go through each one of these. And if you have any questions, feel free to email me if you need me to expand on something. All right, so again, here's some facts about sole proprietorships and partnerships and corporations, some statistics that you may be interested in. Here's how and this figure is in your book, how a corporate organization is laid out. Here is the shareholders, which are us, otherwise known as the owners. And you'll notice here we elect, right, the board of directors, who then hire all the managers of the company. And remember, the board of directors work for us, but sometimes things happen and the board of directors are in cahoots with the managers, and a lot of illegal things go on. But, just bear in mind that we elect the board of directors, and everyone here should be beholden to the shareholders because we're the true owners. Again, here's some more career opportunities in managerial finance. You could be an analyst, capital expenditures manager, a project finance manager, a cash manager, and on and on. So you can go through these. And again, if you have questions, feel free to email me. All right, this is probably the most important slide in this chapter. And as I said, what's real important is this line right here. What's the goal of the firm and the people who run it? To maximize shareholder wealth. And the managers have to make some decisions to maximize our shareholder wealth. And if they're going to take on projects, they're going to make sure they take on projects that provide a large return. And the only way you get a real large return is if you take risk. And the overall goal is to increase share price, which again will maximize shareholder wealth. So please remember that sentence as the goal of the firm. Maximize shareholder wealth. All right, so if we look at slide 17 here, or 16, basically you'll notice here that there's 2 investments in a company, and which investment is preferred. And if you look at the earnings per share for rotor and valve investments, it may look like valve is the better investment because of the overall value of 3 versus 280. But however, what you may notice here is that the money that the earnings per share come early. And if you look at Rota gets earnings per share that are earlier on. They make $1.40 and $1 versus only 60 cents and $1. So in reality, you got to look at the timing of the cash flows and the profit maximization. It fails to account for risk, right? Because you don't know if there's any risk here. And so sometimes the profits don't come to you as shareholders, right? They may keep them as retained earnings. So just bear in mind, timing is important. And just because this one's got a larger total for 3 years doesn't make it the better one. All right, so besides the shareholders, we have what's known as stakeholders, right? And the stakeholders are the employees who work there, the customers, the suppliers, the creditors. We're also the stakeholders, the owners, right? We're the shareholders and stakeholders, and others who have a direct economic link to the company. And basically, what the managers have to do is they have to make sure not only the shareholders but all the stakeholders are taken care of. The goal again is not to maximize stakeholder well-being, but to preserve it, right? You want to keep the company going forever and have it be socially responsible so employees can stay employed, and the small companies who provide products to you can stay afloat, right? So you want to preserve your company for the stakeholders' well-being. Okay, so you may take a course on your own on business ethics, and you can read up on that in the book. And there may be another course you'll take on ethics about how to using good moral judgment. So I'm going to just kind of go past these, and you can read these on your own. If you have any questions on ethics, just email me and let me know. Okay, so the size and importance of the managerial finance function depends on the size of the company. Large companies will have a huge managerial finance function, as opposed to a smaller company which may only have one person doing multi-tasks, such as the accounting and the finance and all of those at once. So a lot of it depends on the size of the firm. And again, we saw this already. Here is the corporate organization for the second time that we saw. And here's the chief executive officer, and here's the chief financial officer. And you got a treasurer and a controller. And all right, so what's an important concept is marginal cost benefit analysis. And here's a simple example, which I'm going to show you, of marginal cost benefit analysis. And assume you are looking to buy a new computer. So the new computer is going to cost $10,000, but you do have some benefits with the old computer, which amount to $3,000. So ultimately, you will add $7,000 in benefits if you buy the new computer, okay? And basically, the cost of the new computer is going to be $8,000, but you can sell the old computer for $2,000, so you have benefits of $7,000 here, and the cost of $6,000. So if you subtract the benefits from the costs, you will have a net benefit here of $1,000. So it's worth buying that new computer. And this is called marginal cost benefit analysis. And you should understand what's going on here. And if you don't, just again, let me know. Okay, so another thing that one has to be careful about is accounting versus cash. Financial accounting is basically accounting where you don't actually take into account the cash. So finance and accounting are different items. Notice here you just sold a yacht for $100,000, or maybe even a car or a house, but you didn't collect the money yet. Does everyone see that? The funds are still not collected. Okay, but meanwhile you had to buy this yacht to put it on your lot. So the yacht cost you $80,000, and you already paid for that. But over here, you sold the yacht, but you didn't get paid. So there's two ways of looking at this problem now. Okay, and you can look at it two ways. And if you look at it from the accounting standpoint, right, which is accrual basis, the sales revenue, even though you didn't get it yet, is $100,000 and the cost was $80,000. So from an accounting standpoint, you've made $20,000, which is a little fictitious because again, you have not collected the money yet. But from an accounting view, you've made $20,000. Now here's the financial cash basis view. You didn't bring any cash in yet, so that's still zero, right? And you shelled out $80,000 for that boat. So you're in a hole. Notice the parentheses, meaning you're negative $80,000. Here you're positive $20,000, even though you didn't collect money. And here you're negative $80,000 because there was nothing came in yet. But that's two different views. One's called the accounting view, and one's called the financial view. And here's a personal finance example. And you'll notice here's your inflows and outflows. And you'll notice you're in a hole here for minus $215 if you take the difference there. So go over that and make sure you clearly understand that. Okay, this is a very, very important sheet, and this is called a balance sheet. And we're going to be going over a lot of these balance sheets in the next couple days. So the balance sheet has a line down the middle, right? And basically you see that line going this way. And the short-term current assets are here, and the long-term fixed assets are here, and the short-term current liabilities are there, and the long-term liabilities are here. The most important thing you have to understand with regard to the balance sheet is when you're looking at the left and the right, the left side has to equal the right side. So I'm going to put an equal sign here. So what's over here will have to equal there. Okay, so please make sure you understand that and review that. And we'll get into more of that in Chapter 3. Okay, so the rest of this is pretty much about government regulation and the Sarbanes-Oxley Act, which was brought into account because of accounting scandals. And the Sarbanes-Oxley Act, if you can look it up on on Google, it's an oversight board to monitor the accounting industry so no irregularities occur. Okay, so because there was a lot of irregularities several years ago. So please look this up and make sure you understand what the Sarbanes-Oxley Act is. And you could go on Google and you'll find that out. If you have questions about it, let me know, and I will send you items on that. Okay. And the other important thing is this whole concept of an agency problem. And an agency problem is when the managers don't worry about you people, the shareholders. All they care about is themselves and not your goals. Okay? So this is an important concept that you should be aware of. And, read up on what the agency problem is. The managers are supposed to take care of the shareholders. Okay, so basically, a lot of times there are incentive plans to make sure the managers do their jobs and make money for the shareholders, and it's compensation you would get, and it ties management compensation to share price. So you could do that, look at that. And there's just an interesting slide here you may want to look at on slide 41. And they just show some chief executives and the company they work for. And you'll notice the compensation and the stock return. So, for instance, Larry Ellison was paid $96.2 million a year in 2012, and the stock went down 22%. So, obviously, he's not doing his job. So, some companies do better than others. But, you'll notice some of these really have dropped tremendously. Here, down 16%. But the salaries, as you all know, are huge for CEOs. All right, so that's about it. And that's all I want to have to say for, for Chapter 1. If you have any questions, please watch this video. And if you have any questions, email me. Please make sure you join the Zoom team. So I will email some people who are new arrivals.